The signs didn't arrive all at once. They rarely do. At first, it was subtle, almost easy to ignore. A home that would have sold in 3 days now sat for 3 weeks. Then 6. Agents began lowering prices, not dramatically, just enough to test the market. But the market didn't respond. And that's when the silence began. For years, the housing markets across the Western world had been defined by one thing: relentless demand. Cities expanded outward. Suburbs filled faster than they could be built. Buyers competed fiercely, often paying above asking price, waiving inspections, rushing decisions. It felt unstoppable. But what most people didn't realize was that this demand wasn't entirely organic. It was engineered. To understand what's happening now, you have to go back. Not to last year. Not even to the pandemic. Further, back to the aftermath of the 2008 financial crisis. When global housing markets collapsed during that crisis, central banks made a decision that would shape the next decade. They lowered interest rates dramatically, and they kept them there for years. Money became cheap. Borrowing became easy. And housing, once just a necessity, transformed into something else entirely. An investment machine. Low interest rates didn't just help buyers. They changed behavior. Investors entered the market at scale. Institutional money, funds, corporations began purchasing homes in bulk. Entire neighborhoods quietly shifting ownership. Why? Because real estate had become predictable, reliable, profitable. At the same time, governments encouraged homeownership. Policies favored buyers. Lending expanded. Credit became more accessible. And slowly, a powerful cycle formed. Prices rose, demand increased, right arrow prices rose again. Then came 2020. And everything accelerated. When the world paused, something unexpected happened in housing. Demand didn't fall. It surged. Remote work reshaped priorities. People no longer needed to live near offices. Space became more valuable than proximity. Urban density lost its appeal, at least temporarily. So buyers moved. From cities to suburbs. From apartments to houses. From expensive regions to slightly less expensive ones. At the same time, something else happened. Governments injected liquidity into the system at unprecedented levels. Stimulus checks. Low mortgage rates. Loose financial conditions. It created a perfect storm. Suddenly, millions of people had both the motivation and the means to buy homes. And they rushed in. Listings disappeared overnight. Bidding wars became normal. Prices didn't just rise, they surged. Double-digit increases year after year. In some Western markets, home values jumped 30%, 40%, even 50% in a short period. And yet, demand kept pushing higher. Why? Because people believed something simple. Prices would keep going up. That belief is powerful. It turns buyers into competitors. It turns hesitation into urgency. It turns housing into a race. And for a while, that race had no finish line. But beneath the surface, cracks were forming. Small at first, almost invisible. Affordability began to erode. Quietly, as prices climbed, incomes didn't keep pace. Monthly payments grew heavier. Down payments became harder to save. First-time buyers found themselves pushed further out or locked out entirely. Still, demand remained strong. Because one factor continued to support it. Cheap money. Mortgage rates stayed low, historically low, and that made even expensive homes feel temporarily affordable. But that balance was fragile, because it depended on one condition: that rates would stay low indefinitely. They didn't. As inflation began rising globally, central banks were forced to act. And fast. Interest rates increased. Not gradually, but aggressively. In a matter of months, borrowing costs doubled, then tripled. A mortgage that once felt manageable suddenly didn't. Monthly payments surged. Affordability collapsed almost overnight. And this is where the shift truly begins. Because demand in housing is not just about desire. It's about ability. People may want to buy homes, but if they can't afford the monthly payment, they step back. And that's exactly what started happening. At first, it showed up in small ways. Fewer offers per listing. Homes staying on the market longer. Price cuts becoming more frequent. Then something more noticeable. Buyers stopped rushing. They started waiting. Watching. Questioning. What if prices fall? What if better deals come later? What if this isn't the right time? These questions changed behavior. And behavior changed the market. Because housing demand is psychological as much as financial. When people believe prices will rise, they act quickly. When they believe prices might fall, they hesitate. And hesitation spreads. Soon, it wasn't just individual buyers stepping back. Investors began pulling out. The same investors who had fueled demand during the boom started reassessing. Higher interest rates meant lower returns. Rising prices meant thinner margins. And increasing uncertainty made the risk harder to justify. So they slowed their purchases. Some stopped entirely. Others began selling. And with that, a key pillar of demand weakened. But the shift didn't stop there. Sellers began to notice the change. At first, they resisted it. They listed homes at peak prices, expecting the same frenzy, the same competition, the same outcomes. But the buyers weren't there. Weeks passed, then months. Price reductions followed. And slowly, expectations adjusted. This is how markets turn. Not with a crash, but with a realization. The realization that conditions have changed. That what worked before no longer works. And in the Western housing market, that realization is spreading. Demand hasn't just slowed. In many areas, it has collapsed. Not disappeared entirely, but dropped sharply from the levels that once defined the market. And the consequences of that shift are only just beginning to unfold. Because when demand falls, everything else begins to change. Prices, inventory, seller behavior, investor strategy, and perhaps most importantly, confidence. So the question now isn't just, why has demand collapsed? The real question is, what happens next? Because history shows us something important. Housing markets don't move in straight lines. They move in cycles. And when a cycle turns, it rarely stops halfway. At first, it looked like a pause. Not a collapse. Not a crisis. Just a market catching its breath. Listings were still coming in. Buyers were still looking. But something felt different. The urgency was gone. Homes that once triggered bidding wars now triggered questions. Is it priced too high? Will it drop next month? Should we wait? And that single shift, from urgency to hesitation, began to reshape everything. Because housing markets don't depend on activity alone. They depend on momentum. And momentum had broken. By mid-cycle, the data started to confirm what agents were already feeling on the ground. Pending sales declined. Mortgage applications fell. Transaction volumes dropped sharply across multiple Western regions. But prices, they didn't fall immediately. And that confused many people. How can demand fall but prices stay high? The answer is simple. Sellers were anchored to the past. They remembered last year's offers, last year's bidding wars, last year's peak prices, and they priced their homes accordingly. But the market they were trying to sell into no longer existed. So listings began to accumulate. Inventory, which had been extremely tight during the boom, started to rise. At first slowly, then more noticeably. More homes on the market means more choice. More choice means more competition among sellers. And that's when the first real cracks appeared. Price reductions. Not dramatic at first. Just small adjustments. A few thousand here, a percentage point there. But they became more frequent. Then more aggressive. Because the longer a home sits on the market, the more pressure builds. Buyers notice. They ask questions. They negotiate harder. And sellers, faced with silence instead of offers, begin to react. This is where psychology flips. During the boom, buyers feared missing out. Now sellers began to fear something else. Being stuck. A home that doesn't sell. An asset that doesn't move. A price that keeps slipping. And that fear changes behavior quickly. Some sellers pulled their listings off the market. They decided to wait. Others couldn't. Job relocations. Financial pressure. Life changes. They had to sell. And those sellers set the new prices. Because in any market, it's not the optimistic seller who defines value. It's the motivated one. And as more motivated sellers entered the market, comparable prices began to shift downward. Not everywhere at once, but in specific pockets first. Cities that had seen the fastest growth during the boom became the most vulnerable during the slowdown. Places where prices had stretched far beyond local incomes, where affordability had been pushed to its limits, where demand had been fueled not just by need, but by speculation. Those markets started to soften faster. Homes sat longer. Price cuts were deeper. Buyer interest faded more quickly. And slowly, the data turned into a pattern. Falling demand, rising inventory, increasing price reductions. A feedback loop. And once that loop begins, it becomes difficult to stop. Because every price cut sends a signal. To buyers, it says, wait, better deals may come. To other sellers, it says, adjust, or risk being left behind. And to investors, it says, recalculate. This is where another critical shift began. Investors, who had once been aggressive buyers, started becoming cautious observers. In the boom phase, the math was simple. Buy right arrow, hold right arrow prices, rise right arrow profit. But now, the equation had changed. Higher borrowing costs reduced cash flow. Slower appreciation reduced upside. And the possibility of price declines introduced risk. So many investors stepped back. Some paused acquisitions. Others redirected capital to different assets. And a few began selling, not in panic, not all at once, but enough to matter, because investor activity had become a meaningful part of demand in many Western housing markets. When that demand weakens, the impact is amplified. Meanwhile, another group began to feel the pressure. Home builders. During the boom, builders raced to keep up with demand. Permits increased. Projects expanded. New developments launched. But construction operates on a delay. Homes that were planned months, sometimes years earlier, were now being completed in a very different market. A market with fewer buyers. So builders faced a choice: hold prices and risk unsold inventory, or cut prices to move homes. Many chose the second. But instead of simply lowering base prices, they used incentives, rate buydowns, closing cost assistance, upgrades included for free, quiet ways to reduce the effective price, without signaling a full market drop. Still, the effect was the same. Prices were softening, and buyers noticed. They compared resale homes with new construction deals. They negotiated harder. They waited longer. Because, for the first time in years, they had leverage. And leverage changes everything. The balance of power was shifting. From sellers to buyers. But shifts like this don't happen evenly. Some areas held up longer. Markets with strong job growth, limited supply, or high-income buyers showed more resilience. But even there, the pace slowed. Because housing markets are connected. What happens in one region influences another. As demand weakens broadly, confidence weakens with it. And confidence is the invisible force behind every housing cycle. Without it, transactions slow, prices soften, and uncertainty grows. By this stage, the narrative had changed. It was no longer about a hot market cooling. It was about a market adjusting to a new reality. A reality defined by higher rates, lower affordability, more cautious buyers, and increasing supply. And that adjustment was far from over. Because historically, housing corrections don't happen instantly. They unfold in phases. First, demand weakens. Then, prices begin to decline. Then, something deeper happens. Pressure builds on homeowners, on investors, on the system itself. At this stage, the shift is no longer subtle. It's visible, measurable, unavoidable. What began as hesitation, then turned into declining demand, is now becoming something more serious. Pressure. Because housing markets don't just react to numbers. They react to stress. And that stress is starting to surface. At first, it shows up quietly. A homeowner misses a refinancing window. Another realizes their adjustable rate mortgage is about to reset. An investor notices their rental income no longer covers rising costs. Individually, these moments seem small. But together, they begin to form a pattern. And that pattern leads to one outcome: selling. Not optional selling. Not strategic selling. Forced selling. This is where the market changes character. Because earlier in the cycle, sellers had control. They chose when to list. They chose their price. They waited for the best offer. Now, some no longer have that luxury. Rising interest rates didn't just affect new buyers. They affected existing homeowners too, especially those who bought recently. During the peak years, many buyers stretched financially to secure homes. They locked in at high prices. Some used adjustable rate loans. Others relied on minimal down payments. It worked as long as conditions stayed favorable. But conditions changed. When rates climbed, refinancing became difficult or impossible. Monthly payments rose for those with variable loans, and household budgets tightened under broader economic pressure. Inflation didn't just affect housing. It affected everything: food, energy, transportation, and suddenly the margin for error disappeared. This is where financial pressure begins to translate into market action. A homeowner who once planned to hold long-term now considers selling. An investor who expected steady returns now sees declining margins. A landlord facing vacancies or tenants unable to pay higher rents reassesses the situation. And slowly, listings begin to rise again. But this time, the reason is different. Earlier, inventory increased because homes weren't selling quickly. Now, inventory increases because more people need to sell. That distinction matters because motivated sellers behave differently. They price more aggressively. They accept lower offers. They prioritize speed over profit. And those transactions reset the market. Comparable prices drop. Appraisals adjust. Expectations shift again. This is how declines accelerate. Not through panic, but through accumulation. More listings, more price cuts, more motivated sellers, and fewer buyers willing to step in. Because by now, buyers are watching closely. They see prices softening. They hear about reductions. They notice homes sitting longer. And they think, maybe it goes lower. That belief spreads. And when buyers expect future declines, they delay decisions, which reduces demand even further, which increases pressure on sellers, which leads to more price reductions. A cycle, self-reinforcing. At this stage, certain markets begin to stand out. Not all areas experience the same level of stress. The most vulnerable tend to share specific characteristics. They grew rapidly during the boom. Prices rose far beyond historical trends. Demand was driven heavily by migration or speculation. In these markets, the reversal is sharper. Homes that once attracted multiple offers now struggle to attract one. Price cuts become larger. Time on market extends significantly. And in some cases, sellers begin competing directly with each other. Undercutting, listing below recent comparables, offering concessions, all to secure a buyer before conditions worsen. Meanwhile, stronger markets resist for a time. Areas with constrained supply, stable employment bases, higher income buyers, they don't fall as quickly, but they don't remain untouched, because the forces at play are broader than any single city. Interest rates are national, even global. Economic sentiment spreads. Financial conditions tighten everywhere. So even resilient markets begin to slow. Not collapse, but soften. And as that softness spreads, the narrative becomes harder to ignore. The housing market isn't just cooling. It's correcting. At the same time, another layer of pressure begins to build. Equity. During the boom, rising prices created a sense of financial security. Homeowners saw their equity grow rapidly. They felt wealthier, more stable. But when prices begin to fall, that perception changes. Equity shrinks. For most homeowners, it remains positive. But for those who bought near the peak, with minimal down payments, the margin becomes thin. And in some cases, it disappears. Negative equity. Owing more than the home is worth. This doesn't immediately trigger selling, but it creates vulnerability. Because if life forces a move, selling becomes complicated. And in extreme cases, it leads to distress. Now, this isn't 2008. Lending standards were stronger. Speculative construction was more controlled. Banking systems are more stable. But that doesn't mean there's no risk. It simply means the mechanism is different. Instead of a sudden collapse driven by bad loans, this cycle is driven by affordability and sustained pressure. Slower, but still powerful. And as pressure builds, it begins to influence behavior at every level. Buyers hesitate. Sellers adjust. Investors retreat. Builders slow down. Each decision reinforces the next, until the market reaches a tipping point. Not a crash, but a phase where declines become more visible, more accepted, more real. And once that happens, the conversation changes again. Should I buy now? How much further could this go? That question defines the next phase. By now, the shift is no longer debated. It's recognized. The signs are everywhere. Price reductions, rising inventory, falling transaction volumes. But the real story isn't just that demand has collapsed. It's what happens after that collapse. Because housing markets don't stop when demand falls. They adjust. And that adjustment creates winners, losers, and entirely new dynamics. At this stage, the differences between markets become impossible to ignore. Some cities bend. Others break faster. The hardest-hit areas tend to share familiar traits. They were the stars of the boom. Prices surged rapidly. Demand flooded in. Migration accelerated growth. Places where buying felt urgent, almost emotional. But rapid growth comes with a cost. When prices rise faster than incomes, affordability stretches beyond sustainable levels. And when conditions tighten, those markets have further to fall. In these areas, the numbers begin to tell a clear story. Listings pile up, not slowly, but noticeably. Entire neighborhoods show multiple for sale signs where there were none before. Homes linger. 30 days, 60 days, 90 days. Price cuts deepen. What started as small adjustments becomes meaningful reductions. And eventually, comparables reset lower. This is the phase where declines become visible to everyone. Not just analysts, not just agents. Everyone. Buyers see it in listings. Sellers see it in offers. Homeowners see it in estimated values. And that visibility changes behavior again. Because now, the idea of falling prices is no longer theoretical. It's real. And when price declines become real, They begin to influence decisions at scale. Some homeowners choose to sell early, not because they have to, but because they want to protect equity. Others wait, hoping for stabilization, hoping the market finds a flaw. Some will be right, some won't, because timing the housing market has always been difficult. Meanwhile, buyers gain something they haven't had in years: time. They can negotiate, compare options, walk away. Power has shifted, but with that power comes caution. Because even as prices fall, affordability doesn't necessarily improve immediately. Higher interest rates still weigh heavily on monthly payments. So buyers face a paradox: lower prices, but higher borrowing costs. And that balance determines how quickly the market stabilizes. If rates remain high, demand may stay subdued. If rates ease, buyers may return faster. But even then, the psychology has changed. The era of urgency is over, for now, and replacing it is something quieter, more deliberate. A market driven by necessity rather than fear of missing out. This is how cycles reset. Excess is removed. Expectations adjust. Behavior normalizes. But the path to that reset is rarely smooth, because along the way there are consequences. Builders slow new projects. Fewer homes are started. Developments are delayed or cancelled, which eventually leads to something interesting: a future constraint on supply. Yes, even as inventory rises now, the seeds of the next shortage are quietly being planted. This is the paradox of housing cycles. Today's slowdown often creates tomorrow's scarcity. And that's why housing rarely stays depressed forever. But the timing is uncertain. In the short term, pressure remains. Sellers adjust expectations. Buyers remain cautious. Investors stay selective. And markets continue to search for balance. In some cities, that balance may come quickly. Prices stabilize. Demand returns gradually. Confidence rebuilds. In others, the adjustment may take longer. Deeper price declines. Longer selling times. More pronounced shifts. Because not all markets start from the same place. Those that stretched the most often correct the most. And as this process unfolds, a new phase begins to emerge. Opportunity for patient buyers, for long-term investors, for those who understand cycles and don't chase peaks. Because every housing cycle follows a pattern: expansion, peak, correction, stabilization. We've moved past the peak. We're in the correction. And somewhere ahead, stabilization waits. But before that happens, the market has to finish what it started. Repricing, not just of homes, but of expectations, of what buyers can afford, of what sellers can expect, of what investors are willing to risk. And that repricing is still underway. So when we say Western housing demand has collapsed, it's not the end of the story. It's the turning point, the moment when a decade-long trend shifts direction. And what comes next will define the next decade of housing, not just in prices, but in behavior, in strategy, in opportunity. Because the biggest changes in markets don't happen during the boom. They happen after it ends. And right now, that's exactly where we are.